The troubled U.S. housing market got a bit of good news today with word that some prices are rising, but full recovery remained a long way off. 4 cities, Chicago, Minneapolis, Washington, and Boston, posted the largest increases in the latest Case-Shiller Home Price Index. But prices in Detroit, Cleveland, Las Vegas, and Phoenix were selling at the same levels as January of 2000, more than 10 years ago. What's more, the survey of 20 cities found overall home prices have actually fallen over the last 12 months. And home sales for this year are on track to be the worst in 14 years. And things could get worse yet once banks pick up the pace on millions of foreclosures as expected. They've been delayed by a government investigation into mortgage lending practices.
Prosecute the criminals, Attorney General!
Amid anger over the bank's handling of foreclosures, 36 state attorneys general and the Obama administration have been trying to negotiate a settlement with the 5 largest mortgage servicers. It could include a lump sum settlement of more than $20 billion that states could then use to modify mortgages. Meanwhile, the futures of mortgage giants Fannie Mae and Freddie Mac are still to be determined, with a new plan from the Obama administration reportedly in the works. Fannie Mae and Freddie Mac still back most home loans in the U.S. And for a closer look at all this, we turn to Nicholas Ritsinas, who teaches housing finance and real estate at Harvard Business School, and Guy Cecala, publisher of Inside Mortgage Finance, a housing industry research publication. Nick Ritsinas, we'll start with you. So what do you see in the latest numbers? Is there any sign of hope there?
Well, there's always sign of hope, but the signs are very slim. It's amazing. Interest rates are at a 50-year low, and yet we have such a tepid housing market. And yes, prices have gone up in a number of cities over the last couple months, but they're down from a year ago and really down from where they were almost at the beginning of the decade. So it's still a very difficult, sort of shaky time in the housing market.
Guy Cecala, the uptick such as it is came in the second quarter. The quarter was up, but the year's down. I mean, that's why it was interesting to read the reports this morning, just to parse it.
Yeah, it's a little bit, an emphasis on little bit of good news. You know, most people would say the real number to look at is, the year-over-year change. And as long as we keep declining, that's bad news. I think cumulative, we've already seen a 30% or so decline according to the Case-Shiller index. So this is just more bad news.
And just to help us with it a little bit more, this seasonal adjustment idea, explain that concept, because that plays into how we read these numbers, right?
Well, if you look at typically the housing season is the summer months, so you would expect to see an increase in the summer months if it was just not adjusted. So the difference between the first quarter and the second quarter would generally always be more active than the first quarter. When you factor in the seasonal adjustment, it tends to flatten out the differences a little more.
Now, Nick Ritsinas, fill in the picture a little bit behind the big numbers. Talk about, you mentioned some of the differences in regional and in different cities. What do you see there when you look out?
Well, it's a big country, and some markets are in better shape than other markets. Clearly, in the markets such as the Southwest, South Florida, parts of California, there was such substantial overbuilding that we have a huge excess inventory. In other parts of the country, like the upper Midwest, that have faced severe economic problems, you have struggles on the demand side. So while there are some silver linings, parts of Texas, parts of the Northeast, where you think we're probably at or near a bottom, as long as this foreclosure cloud is hovering overhead, a recovery is going to be in the distance.
But just to fill this in a little bit more, Nick, is it correct to talk about a national housing market at this point, or is it better to think in terms of regional housing markets?
Well, it's better to think in terms of regional because people buy homes in particular neighborhoods, not in the United States of America. However, we do have a national housing finance system, and that national housing finance system is tightening credit, requiring higher down payments. So it is discouraging people who might want to buy, and for those who have the means to buy, they're discouraged because what they see is possible downfall in prices.
What do you see in terms of looking at regionally versus the nation?
Well, generally, there's a lot of difference, as Nick pointed out, between different regions of the country. I guess what's so disturbing about the housing trends now is we're seeing no region of the country posting any increases, and it's just a question of which are posting the largest declines year over year. And also, as Nick pointed out, it tends to be the areas that had the boom and now they're having the bust. Some of the other areas are a little bit flatter in terms of slower declines, but generally every area has seen a decline, and they're seeing a decline this year.
Now, we've all mentioned the foreclosure issue. Let me start with you, Guy Cecala, on this. It seems as though it's somewhat in limbo at this point, given what the attorneys general are doing, what states are doing, legal proceedings. What's going on?
Yeah, backing up a little, one of the things that's pushing housing prices lower is the fact that we have so many distressed property or foreclosed properties that make up housing sales. They tend to have lower prices, and if you compare those to what we saw several years ago, it's naturally going to result in price declines. The issue going on now is that foreclosures have slowed down, and you might think, gee, isn't that good news? But it's not slowing down because unemployment has improved and a lot of people are catching up on their mortgages. It's slowing down because there's this big settlement that the federal government and mostly the state attorney generals are trying to work out with the largest mortgage servicers in this country, and it's bogged down the whole foreclosure process to the point where legitimate foreclosures are being kept out of the market, and that's going to create a backlog going forward.
And the point is that we need this process to take place. As painful as it's going to be, we need the foreclosures to go forward.
Yes, we have somewhere in the neighborhood of 4 million distressed properties out there. Those are either seriously delinquent mortgages or ones already in the foreclosure process. And most of those loans have to be pushed through the system at some point. And the longer we take to get through that, the longer the housing market's going to take to recover.
So, Nick Ratsinas, what is the holdup with the in trying to resolve this issue, particularly with what's going on at the state level?
Well, the state attorney generals are suggesting that because of malfunctions in a dysfunctional servicing system, banks have to be held accountable, have to modify loans and make payments. And the banks, on the one hand, are willing to do that as long as they know that's the end of the litigation. But there are some attorney generals, like the Attorney General of New York, who suggest, no, it's not just the robo-signing, it's not just the bad paperwork, but there are other issues, and we should be able to follow up on those issues also. All of that leads to stagnation and sluggishness, and as Guy said, the pipeline isn't clear anymore.
And so, Nick, staying with you, what difference would it make once a settlement comes through? What difference would it make to consumers and to these banks?
Well, in the short term, it would put probably even more properties on the market, and in the very near term, it might further depress prices. But once we're through with this, we can start dealing with the excess inventory. And when we clear the excess inventory, we can have a supply-demand balance, and that's when you can see a recovery begin.
Now, Guy, the administration also has talked about is sort of a hoped-for plan for new foreclosure settlements. What's going on with that?
Well, they're also trying to work this through, and I think there's a lot of pressure on the administration now to do something to revive the morbid housing market. One of the few things they see is necessary is resolving the foreclosure crisis. As we said, everybody's starting to have agreement now that there's a huge pipeline that has to start moving through the process, and if you keep that backlog, you're not talking about a recovery for 2 or 3 more years. So the sooner you can do it, the better, and that's why I think the administration is trying to goose along this settlement as much as they can. They just haven't had a lot of luck.
Are there things they can do beyond the settlement, that various proposals they're looking at?
Well, keep in mind that they have to, any proposal they look at can't cost much money or any money, which makes it very difficult. One of the few things you hear a lot of talk about these days is utilizing Fannie Mae and Freddie Mac, and particularly all the mortgages that they control, and somehow creating an environment where borrowers who are current on their mortgages but can't refi because of tough underwriting or a lack of equity could suddenly be allowed to capitalize on historically low rates. That would pump some more money into the economy and certainly help tens of thousands of people lower their mortgage payments.
Nick Ratsinas, what are you hearing in that regard in terms of what proposals might be on the table for dealing with the foreclosure settlements?
Well, a couple weeks ago, the administration put forth a request for information, a request for ideas dealing with the foreclosed properties. They seemed to indicate they were open to investors buying large pools of foreclosed properties and perhaps convert them into rental housing, somewhat similar to the Resolution Trust Corporation over 20 years ago. So that's what they're looking at, because they too come to that same conclusion. Until we get the foreclosures through the pipe, we're not going to be able to establish what the market clearing price is.
Now, Nick, one last big issue hanging out there, and we just heard you mentioned Fannie Mae and Freddie Mac. Clearly, the administration, a lot of conjecture about their future, but clearly, Nick, the administration is treading carefully here as well, right?
Absolutely. And in some ways, ironically, there's consensus on both sides of the aisle that Fannie Mae and Freddie Mac can continue in any way, shape, or form similar to their current structure. But on the other hand, the housing finance system and the housing market is so fragile, these entities are providing life support. So they're between a rock and a hard place in determining how to proceed and when to proceed.
Is that what you see happening, Guy?
Oh, yes. You know, in the first half of this year, we tracked numbers, and Fannie Mae and Freddie Mac were accounting for 70% of all new mortgages being made.
Still that high.
Still that high. And when they're
even after all these years of the problems.
Exactly. And when they're doing that, you really can't talk about dialing them back or changing them dramatically. And I think it really puts a serious debate on that on hold for a year or two. There's really nothing you can do.
So, but are there serious proposals on the table, or literally at this point, it's just got to get to the next step before we can think about that?
I think we have to get to the next step. Also, when you talk about serious proposals, the biggest complaint is what Fannie and Freddie did in the past. I don't think anybody's complaining what Fannie and Freddie are doing now. And so do we want to create new entities or authorize private companies to do what Fannie Mae and Freddie Mac are doing well right now? It makes it a very difficult decision.
So, Nick Ratsinas, just to bring it full circle here, now we're in the fall season. What do you look at normally in the housing market? What's supposed to happen? What do we need to happen next?
Well, I go back to foreclosures, foreclosures, foreclosures. As long as foreclosures, distress sales, short sales are 30, 40% of the market, there's going to continue to be downward pressure on prices. So I'm afraid the silver linings we saw in the numbers today may only be temporary.
Closing word?
I agree 100%, what Nick said. The foreclosure situation is the real nut that has to be cracked, and that's going to take time to do it, and we're not making any progress on it. In fact, we're delaying it.
All right. Guy Cecala, Nick Ratsinas, thank you both very much.
You're welcome.